Bill Ackman is the CEO of Pershing Square, a hedge fund management company. During the COVID-19 pandemic, Bill was able to convert millions into billions, while other investors struggled in the stock market. In this video, we will learn about Bill Ackman's 9 investing mistakes, so that hopefully you and I can find opportunities to make millions. Mistake number 1, not doing your due diligence.
Experience is making mistakes and learning from them. So that's what I learned. I went to business school to learn how to be a good investor. And I learned the first rule of investing, which is you do your due diligence before you wire in your money. And when I got to HBS, I actually opened the course catalog for the first time, and there wasn't a class on investing. Now, there were classes on accounting, there were classes on finance. So I decided I had to develop my own little self-study program. And I wanted to, so I opened a Fidelity brokerage account. And I said I had some money I'd made in the real estate brokerage business. This was my tuition in the investment business. And it was about a year of tuition. And if I lost it, it was as if I had gone to business school for 2 years but paid for 3. So I figured it wasn't, it's like the inverse of the Oxford 1+1 program. But the first stock I bought went up, and I said, okay, I found what I want to do. The answer is I was an entrepreneur, and I felt that I wanted to approach investing my own way as opposed to learn from someone else. And it's one of the few things you can really learn on your own. You can learn investing by reading books, by reading annual reports, by having you can have a portfolio and invest $100, and you can learn the business, unlike many other businesses which require a lot.
Mistake number 2, not having a sense of discipline.
Principles are basically, we want to invest in simple, predictable, free cash flow generative, dominant companies with large barriers to entry, that earn high returns on capital, that have limited exposure to extrinsic risk we can't control, strong balance sheets, don't need access to capital to survive, have excellent management, good governance. Sounds logical, but occasionally we've diverged, and there's those times, there's a certain discipline that comes with investments, and there always seems to be a countervailing quality that caused us to diverge. But in really each case where we've compromised on business quality or complexity, we've been harmed.
Mistake number 3, ignoring long-term investing.
I hate to be boring on this. I do think Buffett is the greatest investor. And the reason why I believe that is, this is a 50-odd year, it's a 60-year track record of compounding at 20+% with a very modest amount of leverage, in the form of principally insurance float. And I just don't think there's a record that compares. And I also think that what he does actually creates value for the world. I think George Soros is an incredible investor, but I think what he does as an investor creates no value for the world. No, I think what he does as a philanthropist, I think he creates a lot of value. So I think Buffett has the benefit of, I think Heinz will be a much better business by the time, as a result of Buffett's ownership. You look at what he did with Geico since he bought it. I think he's created he's bought businesses well, but not incredibly well, as he's gotten to be quite large, but he's made those businesses much more valuable. And I think he's also created a lot of messaging that's affected the way people think about executive compensation and derivatives. So I think he's made an enormous contribution. So I think it's a combination of long-term, kind of longitudinally, and the accomplishments he's had. So I think he's the best, by far the best.
Mistake number 4, not investing in moats.
We look for very high quality businesses, what we describe as simple, predictable, free cash flow generative, dominant businesses, a business that Warren Buffett would describe as having a moat around it, right? If you believe that the value of anything financial is the present value of the cash you can take out of it over its life, well, you need to know how much cash it's going to generate over its life. So business quality to us is the single most important criterion for determining what's interesting. Because if we can't predict the cash flows, we don't know what it's worth. If we don't know what it's worth, we can't invest. So we figure out what it's worth, we figure out how good the business is, how predictable will this cash flows be from a railroad or a spirits company or a real estate company, shopping mall business. And then we say, okay, well, where's it trading? And if there's a wide gap between price and value, you can buy it for 50 cents, it's worth $1.20. Well, then we're going to take a hard look and try to understand why it trades at a deep discount. And once we understand the reasons, we decide, well, these things that we can solve. Or can we, in light of the situation, the circumstances, can we be influential in changing these levers that can cause this valuation discrepancy to narrow? And is this a business that, while we're causing the valuation discrepancy to narrow, we can also perhaps contribute to the valuation growing. Those things are true. We found something that looks quite interesting for us.
Mistake number 5, too much diversification.
Tell us a little about your portfolio. Why so few names? Obviously there has been some rumors of the performance, up 6% for the first quarter. I know you can't say that's accurate or not accurate. With most of your portfolio up double digits, one down to double digits, which we'll talk about. But give us just a take on why so few names, and
So for a bunch of reasons. I mean, I've always had the view that why not own the best 10 or 11 investments as opposed to ideas 12 through 25 or 12 through 100, which is more typical. And I think there are very few great investments at any one time. So the ability to concentrate is an enormously valuable asset of a strategy. The problem with it is it leads to bumpier returns, and it leads to more attention on mistakes or things that aren't going well. I don't know a portfolio manager that doesn't have a stock that's down in his portfolio, right? But you don't read articles about, we're getting an awful lot of attention for a pretty high profile situation that's struggling. But I think there's, it depends on what your business model is. But if you want to make high rates of return over a long period of time, it's hard to do that being very diversified. I mean, if you look through the Forbes 400, wealthiest people in the world, most of them made their fortune in one business or a portfolio of 2 businesses. Very few made it in a portfolio of 100. So it's that, and the other benefit, it allows you to run a much simpler investment firm. We have an 8-person investment team. If we had 30 names, we couldn't manage that portfolio the way we do with a small team. By having a small team, you can hire better talent.
Mistake number 6, not learning more.
If you're going to be successful in your career, you're going to make some money. And how you invest that money can make a big difference in the quality of life that you have and perhaps that your children have, or the kind of house you're able to buy, or the retirement that you're going to be able to enjoy. And we talked about the difference between a 10% return and a 15 and a 20% return over a very long lifetime, what impact that has in terms of how much wealth you create over the period. So investing is going to be important to you whether you like it or not. And learning more about investing is going to have a big impact on your quality of life. If money is something that you need in order to meet some of your goals. I got interested when I was probably 22 or 23. I started interested in being an investor, and I read a book. I read a book called The Intelligent Investor. It was written by Ben Graham, and Ben Graham is a famous value investor. And it's kind of like reading Jean-Paul Sartre's essays on existentialism. You read it and it either is an epiphany and affects the way you live your life, or it's of no interest to you. And this was the equivalent, but in investing, I found it fascinating. And what I liked about investing is something very accessible even to someone who's 22 or 23. What's kept me intrigued is that it's one of the few jobs where every day you can study something new. You're constantly learning about new businesses, new situations, new management teams, new issues. So it's infinitely challenging. And the world and the stock market are obviously very dynamic places, so the challenges continue. These same concepts, while they're useful in deciding how to invest your portfolio, they're also very useful to you in thinking about decisions like buying a home, making decisions in your line of work, whether to hire additional people. These kinds of calculations and thought processes are helpful, and they're helpful in life. And I recommend that you learn more.
Mistake number 7, failure to understand the business.
I think the best thing, in the investing business, you can learn by reading. Read everything Warren Buffett's ever written, watch every YouTube video he's ever appeared in. That's a great way to learn about investing. But investing is more than just, the way to really understand investing is to understand a business. And one of the most important skills you need as an investor is distinguishing between a great business, a good business, a fair business, and a bad business. And one way to get a sense of the quality of a business is go to work for one. So the recommendation I give to people graduating from business schools these days is this is the greatest time in history to work for a startup. There are lots of incredibly interesting businesses being formed. And if you can be one of the early employees, you're going to learn a lot about how a business works, how to make payroll, how to market your product, how to design something. And those skills I think are invaluable. First of all, you might even find it really interesting. You might have joined the next Facebook, so that's one thing. Even if a business fails, you'll learn a ton from that. I think that's the best experience you can get, ultimately, to be a good fundamental investor. In terms of the future of fundamental investing, I don't think everyone can be a passive investor, and I don't think everyone can be a quantitative
trader. And I think there will be always room for fundamental value investing because fundamentally stocks are driven and business value is driven by business fundamentals, not supply and demand for securities in the short term, not the weather on certain days and the various signals that are used by quantitative traders. I'm not saying there's anything wrong with it, but I don't think that even quantitative trading works unless there are a lot of people making fundamental investment decisions.
These investing mistakes are what you need to look out for before considering any investments in order to ensure long-term wealth. As Bill Ackman said, you should learn more. If you're ready to apply that principle, check out some of Warren Buffett's investing mistakes. Until next time, take care.